Hello everyone, Joe Mass here. I'm Chief Investment Officer for Synergy Asset Management. Today I'm going to take you through our third quarter update. So we'll go through a review, we'll look at inflation, interest rates, corporate earnings, the Fed, the VIX, and we'll give you our thoughts on what's to come. So as we look here at the broad market indexes, we're going to look at stocks, bonds, emerging market, commodities, and international stocks. You can see that really the bright spot has been the commodities. It was up 4.79% for the quarter. Everything else has been pretty flat to slightly negative. The emerging market is an outlier, being down 8.65%. So again, it's been a tough quarter for broad asset classes, and it's really been the inflation play in the commodities that's been the winner. Now let's look at market cap and style. So you can see here in the white, large cap growth outperformed large cap value, and large core outperformed small core. So we have large cap growth working, and we have large cap working over small cap. And that is no surprise. We have seen that shifting over the last several months, and we expect that to continue. From that data, we see that the broader exposure has still been in play. It's been beta over focused investing, but only slightly, and we'll give you some more evidence of that. So it's still been a beta market. Active management is coming back into play. We've seen the rotation from value back to growth, and that's continued. And we've seen that size, right, the large companies coming back in favor over those small companies. We've been maintaining our process throughout the quarter. It's a year that we're talking about we have to be patient. There's so much going on. There's so many moving parts that we don't want to try to outthink the market. So all the portfolios have been doing relatively well, and we're just going to need to be patient for the rest of the year. Okay, so what drives the markets? We talk about this every time, it never changes. Inflation, interest rates, corporate earnings, and the Fed. And of course, the geopolitical events like COVID and legislation have a minor or an ancillary effect on the markets, or a temporary effect. They usually give us a sharp spike, right, when the news event comes out, up or down, but they're really not the main factors that drive the market. The main factors are going to be inflation, interest rates, and corporate earnings. So starting off by looking at inflation, okay, inflation now is at 4.3% as measured by the PCE. The University of Michigan's 5-year outlook is at 2.8, and the Fed still has their target at 2. We've been seeing this chart come up all year. We've been talking about this in past videos. We don't expect it to be this high for a long time. We expect long-term inflation to be somewhere between 2.3 and 2.7%, so higher than it has been in the recent past, but not excessively high. So we do think some of this is short-term and will pass, and some of it is here to stay. We're mainly concerned with wage inflation. That's what we're watching more importantly than the PCE number. Okay, so there you go. The blue line represents unemployment, and the unemployment rate has been coming down. Turning to the yield curve, we'll see that the yield curve is positive, so it's not indicating a near-term recession. And we'll see that the 10-year is about 1.6. So we have a positive slope curve. Remember, the 10-year was down below 1. It came up to 1.75. It came back down. Now it's back up to 1.6. So it's been kind of a yo-yo, right? And we continue to watch that. And we would love for it to be higher, because that means we'd have a higher safe yield for you guys in cash and in bonds. But it's going to be maybe some growing pains as we adjust over the next few years as rates come up. The 10-year bond, again, there you can see that the high at 1.7 was on 10/21. The low was on August 19th at 1.2, and the average has been 1.45. Currently we're at 1.6. Now, why do we talk about the 10-year bond? Because it really drives mortgages. It drives the equity risk premium and the valuation of equities. It affects the bond return. So it's really a primary indicator that we look at to understand how asset classes might be performing in the future. So that's why we spend so much time on that. More importantly, turning to earnings, which is really what drives the market, we see that the 12-month expected return and increase in earnings is 19%. So that's still very strong. It's below what we saw earlier coming out of COVID recovery in the 20s. But it's much higher than the long-term trend. So earnings are still looking good. What those earnings equate to is about a 9.63% expected return in the S&P 500 over the next 12 months. Okay, so a little bit above average, a long-term average expected return. So that's a welcome piece of information. When we turn to the Fed and the dot plots, which we've seen before. This is the dots that indicate where they might vote for rates. We're starting to see about half the votes come for higher and half the rates come for remaining the same. So we still don't think rates are going to come up until 2023. However, there is an increasing probability that that the Fed has to raise rates in 2022. The markets won't like that. It would be a short-term spike in volatility, and that would be to be expected. However, we don't believe that we're at the beginning of the bear market yet. So looking at the Volatility Index, we can see that, sometimes called the Fear Index, that since 1989 it's averaged 19.73%, and today we're at 15.8. Doesn't feel like we're in a low volatility environment, does it? There's so much geopolitical risk going on, the market's going up and down, there's all kinds of geopolitical news, so it feels like there's a lot more volatility, but mathematically we're actually below average, so volatility is not our concern at the moment. So let's turn to some market observations. First thing we're going to look at here is growth again versus value, and you can see, we talked about this in a few slides ago, but we can see that growth is starting to come back. And same with the large versus small on the chart on the right, we can see that the large cap is starting to outperform small cap. So we're confirming evidence there. Turning to look at the equal weight versus the market weight, we'll notice three sectors have changed. Consumer staples and financials and utilities have flip-flopped. So consumer staples used to be on a year-to-date basis, equal weighted used to be in favor, now it's market cap. Financials was market cap, now it's equal weight, and utilities was equal weight, and it's now market cap. So what we're seeing here at the market level, year-to-date, is that the equal weight is still prevailing, and that's why it's been a beta market, right? As we've recovered from COVID, all the companies have been starting to recover, not just a few handfuls. But if you want to look at the 4-week and 12-week period, you'll see that the market cap is actually starting to outperform equal weight. So we're starting to see that shift again from the beta play and passive management to active management. So we've had a lot of change going out through the year, and it's been a tug of war, large to small and small to large, growth to value, value to growth, back and forth. And we're starting to see more growth, more large cap, and more active management. That's what we're getting from this data. Turning to the sectors, right now, fundamentally, we prefer financials and energy. And you can see in the yellow bar on the right, the last period ranking. So right now, you'll notice that the market's starting to flatten out a little bit on the sectors, right? We have 3 sectors in the first spot. Then we have telecom and healthcare. Then we have infotech, utilities, industrials, all tied at 6th. And then consumer discretionary and staples at 10. So we're seeing the sectors start to flatten out a little bit further from a fundamental perspective. But again, using a multi-factor valuation model, we do favor the energies and financials. Now when we turn to the technical analysis and we rank our sectors, we're getting the same basic information. So we rank them technically, and you'll see that again, the XLE, the energy sector, and XLF, the financial sector, are still the 2 most highly ranked sectors. So that's good news. It means that our fundamental work and our technical work are both giving us the same answer, and we like that. We have confirmation in our work, okay? Here's another way to look at that sector rotation. You can see this outlier up here. This is XLE, okay, so the energy is really outperforming the rest of the sectors. If you look at the middle here of this chart, this little intersection where my mouse is, that would be the S&P 500. So all of these other sectors are measured relative to the S&P 500, okay? And this means how much are they outperforming the S&P 500. And so you can see that the energy is definitely a winner, and we expect that to continue on for the short term. Going to valuations, here we see that we have cyclicals over growth, but the growth is starting to come in favor. So when this line goes down, okay, it means that growth is in favor over cyclicals. Remember, we talked earlier in the year that cyclicals were making a comeback, okay, but now it's rotating back to growth. Same thing with the industrials. So we're now seeing that those industrials are outperforming the cyclicals, as is the composite of the S&P 500 in the bottom chart on the left. And then, of course, we saw the growth starting to come back here. So again, we're getting confirming evidence throughout our work, and that makes us feel comfortable. On this chart here, we're looking at the valuation metrics of the different sectors. And so you can see that the S&P 500 on a forward-looking PE basis is expected to be 23.4. And so you can see that, again, energy, materials, financials are well below the average PE at the index level. And so, again, that confirms the value in those sectors. Okay, so what are we expecting? Well, we're still pretty bullish on U.S. equities, believe it or not. Starting this year, I didn't think we'd be as bullish now as we are, but we think 22 could end up to be a really good year. International, we're still bullish on their recovery. Emerging market, we're neutral. As the dollar strengthens and as rates come up in the U.S., that will not be good for the emerging markets. However, from a valuation perspective, looking at over the next 10 years, the emerging market space probably provides us the highest return opportunities, just not right now. U.S. fixed income, we're neutral, and real estate, we're neutral as well. So for our outlook, going forward, we expect lower long-term rates of return, okay? Inflation, we're just going to have to let it play out and see where we end up with inflation. So we'll have to wait to see how much has been long-term and how much is short-term. Interest rates, we think they're coming up. We expect the bond purchases to slow down. The Fed may have to raise rates sooner than expected. We'll keep you posted on that. And so again, as we talked about today, we're seeing increased opportunity for that active and tactical management, and asset allocation is going to be boding well in this environment, as well as the stock selection. However, we're going to have to be patient as we get news of inflation and taxes and all the geopolitical events. We don't think that these geopolitical events are going to start the bear market. They could, but we don't have evidence of that yet. But we will have spikes of volatility, so we're going to have to be patient when the markets decide to have small corrections. So we expect small corrections. We do not expect a start of a bear market. So volatility is contained, as we showed you earlier. It's below the long-term average. Taxes, who knows? We're still watching that. It changes every day, but it's definitely a risk that's out there. And then, of course, corporate earnings, which is one of our most important factors we look at, are above long-term trend, and we expect them to continue to be stronger as opposed to weaker, and that should bode well for the equity markets. So overall, we're still on a risk-on environment. We still want to maintain a good amount of exposure to equities as long as you have more than 5 years before you're going to need your money. So we're still in a risk-on mood, and we can rebalance as necessary. And we'll get back to you next quarter with the results and keep you updated with what's going on. But for now, we thank you so much, and we hope you enjoy this. If you have any questions, just give us a call. Thank you again.